Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello trading cats, I'm the risk manager at the Forex Super Model, and this is part 3, the Keynesian cross diagrams, inflationary and deflationary gaps. This is basically a continuation on the economics of the macroeconomic system, relating it to trading. Right, so if you remember, what have we done so far? Parts 1 and 2, quick whistle stop tour. We've basically introduced the concept of the 4 main economic objectives. Stable prices, which is control of inflation, unemployment, maintenance of employment, economic growth, GDP, and stable and consistent balance of payments, which is X minus M, which is the balance of trade, etc. External economy. Right, and then we had the 5th one, which is becoming more relevant, which is a fair and equitable distribution of income and wealth. Right, we then went from the objectives of economic policy to starting to talk about the circular flow, and in order to talk about the circular flow we introduced the 4 factors of production: land, labour, capital and enterprise, and then we talked about the rewards to the factors of production. Right, we then moved on and said that the economy's circular flow is based on the 3 concepts of income, output and expenditure, which we then said identify with each other. They are the same but different. Right, so we then moved on from there and we started looking at the actual way you measure GDP, gross domestic product, and we said you can tap off measures of GDP using the 3 methods of income, expenditure and output. And then we had a quick look in detail at the various formulas of gross national product, gross domestic product and net national product. That was basically there. Then in the next video we draw this in a bit further and we looked at injections and leakages into the circular flow, and we looked at C plus I plus G plus X minus M, and we looked at savings and taxes. We then also looked at this idea of the Keynesian consumption function, which we said had an autonomous element. An autonomous element basically means that it's independent of income. And then we said that there was a function of income as well, the consumption function. We then drew and showed you a consumption function. We then talked about the marginal rate of leakage from the system, and we then finished up talking about the reciprocal of the marginal rate of leakage from the circular flow, which gives us a measure of the Keynesian multiplier, which is a two-edged sword, which basically if you put an injection in, say government spending of 100 million, you get, and the multiplier is 5, you get a 5 times over a period of time, 5 times final increase in GDP. Right, here we are then. So part 3, Keynesian cross diagrams. They're called cross diagrams because the lines cross, and therefore that's the basic reason. Inflationary and deflationary gaps, then we'll move on to those in a minute. But basically we've drawn up here this idea of AD, aggregate demand on the vertical index, and along the horizontal index we've got Y for income, and we know that income identifies with output. And if you remember economic jargon time, aggregate demand is the same as aggregate monetary demand, and aggregate monetary demand is the same as GDP, gross domestic product, at market prices. And GDP at market prices is basically your C plus I plus G plus X minus M on a 4-sector model. And a 4-sector model is households and firms, government sector and international sector, X minus M. Right, so this is where we are then. If you look, we've got aggregate demand then, and income and output. And we've got a 45-degree line. Now 90 degrees, as we know, is a right angle, so 45 degrees is halfway. So in terms of the 45-degree line, we've got aggregate demand equals income at all these points. Right, we then draw our function of aggregate demand, which is the same as aggregate monetary demand, which is the same as GDP at market prices, C plus I plus G plus X minus N. And we draw it in this fashion, and we get this situation here. And where they cross then, so is the point where aggregate demand in our particular economy equals income and output, and this is the point where so we've got Y for income, E for equilibrium. So we've got an equilibrium situation here. But the thing is, the economy can be at equilibrium in terms of aggregate demand and income, but that may not be a desirable point in the economy. For example, it may be below full employment or output. So if we've got like YF here, income for full employment up here, then we've got a situation where we don't have enough C plus I plus G plus X minus N to achieve full employment. Therefore, we've got underutilized resources. We're not operating particularly efficiently. We've got welfare payments. We've got a reduction in the tax base, etc. And therefore, economists or the government, to be more precise, are looking to run the economy as close or as equal to the full employment level of output and income as they possibly can. But there's conflicts with this because as we'll talk about at another time, or maybe a bit later in this video, if you do that, you can generate inflationary pressures. And remember the four main objectives of government policy. Control of inflation is one, and economic growth is another, and also full employment, if you like, and a balance of trade. So that all sorts of ties in. We'll stop it there, and then I'll put the next diagram up for you. Right, welcome back, cats. Right, now we're going to talk about inflationary and deflationary gaps. Now, you've got the same Keynesian cross diagram, so-called. You've got aggregate demand on the vertical axis, income on the horizontal axis. Remember, aggregate demand is the same as aggregate monetary demand is the same as GDP at market prices, and income identifies with output, which identifies with employment effectively. Right, inflationary gap then. The 45-degree line shows the positions where aggregate demand equals income. So these are points of equity. Now let's imagine that the full employment level of income, where we have full employment in the economy as defined really. There's lots of definitions of full employment. We won't get into those, but basically everyone has a job who wants a job and who's capable of working. There's lots of definitions, but let's not get tied up in that at the moment. But basically this level here, so from here to here, is the level of income required to have full employment in the economy, which is an economic objective, and therefore we have a corresponding level of aggregate demand which coincides with this. And let's suppose we designate this aggregate demand F for full employment. So this is this level of aggregate demand, C plus I plus G plus X minus N. Right, and let's suppose our actual aggregate demand, so aggregate demand actual, is above that, is higher. And we can have that situation, say the economy doesn't have to sit naturally at the full employment level. So let's suppose we've got this situation. So we've got demand which is higher than that required to generate full employment in the economy. Therefore we've got inflationary pressures, and this is known as demand pull inflation. So it's demand pull. And it's demand because it's from aggregate demand, and it's generated from an excess or excess demand inflation. Excess demand is pulling prices higher. Right, so we've got this situation for whatever reason. We've got aggregate demand actual, which gives us a level of income A actual, which is higher than that required for full employment, fully utilising resources. Therefore, we get this vertical situation, which is the gap between here, which is known as an inflationary gap. So we've got inflationary pressures to the tune of that gap in the economy at our actual level of aggregate demand. Now that's that situation. Now, if you reverse that out and say that the full employment level is beyond the actual employment level that we're generating at the moment, then we've got underutilized resources. So our actual level of aggregate demand is here, and we need it to be pumped up to here to actually take up the slack, and therefore we've got what's known in the trade as a deflationary gap. So when aggregate demand is insufficient to generate full employment, we have a deflationary gap, and when it's beyond full employment, we have an inflationary gap. And remember how we can close these gaps, open up. So ideally we'd probably want to close that gap, because one of our economic objectives is stable prices. So we've got full employment already, but we're now stoking up prices, so we want to close that gap. And how can we close gaps using the Keynesian approach? And we close it using a negative multiplier. So we need to have bigger leakages in the economy. Remember what leakages are. They're out of the circular flow, and therefore we get a downward multiplier. So we want a bigger downward multiplier. So 1 over the marginal rate of leakage needs to be bigger, and we need to have a situation then over various rounds of expenditure. The economy will come back down to full employment in theory. Likewise, if we want to expand the economy to close this deflationary gap, when we go back to our old example, we might want to inject, say, 100 million of government spending with a multiplier of 5, marginal rate of leakage of 0.2, and then Bob's your uncle, we get, through successive expenditure rounds, we get a closing of this deflationary gap, and we get takes up the slack in the economy, and hey presto, everybody's happy. Right, stop it there and then we'll move on. Hello again, cats. Now, remember we talked about autonomous variables. We looked at that in the Keynesian consumption function. We said that there was an element of consumption, expenditure on goods and services, that was independent of income. Autonomous consumption is basically not related to income. It's the minimum level of income for subsistence and survival, etc. Right. So therefore, the consumption function doesn't start from zero or the origin. It starts from your autonomous level of consumption. Now, the word autonomous, that's an economic term, jargon if you like. Now we've got another one coming, or another two coming up. We've got exogenous. Now, exogenous to the economic system or the economic model. So that's useful to know. Now, what does exogenous mean? An exogenous value is determined outside the model. So it's basically similar but different to autonomous. Autonomous is independent of a function. For example, autonomous consumption is independent of income, whereas exogenous is the value of something determined outside the model. And endogenous, which is the other side of things, is a value is determined within the model. So exogenous, determined outside the model, endogenous determined from within the model. Right. Now, if you remember C plus I plus G plus X minus M, investment then, when we're doing our function here, our aggregate demand function, C plus I plus G plus X minus Z, investment then here, if you look at aggregate demand versus income, in this model we're saying that investment is exogenous to the model. It's not determined by income. It's usually deemed, investment in the economy is usually deemed to be determined by interest rates. So it's usually an inverse relationship between that. We'll talk about investment in detail another time. But so high interest rates tend to choke off investment, lower interest rates tend to encourage it. That's the theory. Right, so, and actually, investment, just as a whistle-stop tour, it may not be determined by the actual level of income, but it's determined by the potential rate of change of income, and that's this thing called the accelerator model. We won't deal with that now, deal with that in later videos, but that's just a primer, if you like. So investment then is exogenous to the model, and therefore it's the same level regardless of the level of income in the economy. Now, government spending likewise exogenous to the model, outside the model, because it's determined by government policy, and government policy is determined by what are the government's aims and objectives. Remember what we talked about those. So we've got a horizontal line for G. Now, exports arguably are not determined by income as well. They're determined by other factors, decisions made by firms, etc. So we'll talk about exports another time. But so you've got these I, G and X exogenous parts of the model, and then you've got these C plus I plus G plus X minus M, basically is our aggregate demand function. Now, that sort of ties in with the this idea of economic jargon then. So that's, we're going to stop it there and just round it up in a second. Right, welcome back cats again. Right then, just to summarise then, blank board here. Right, what have we been talking about? We've been talking about so-called Keynesian cross diagrams, which are a means of seeing where aggregate demand, C plus I plus G plus X minus M, is in relation to the full employment level of income or output. So if you've got, you can have a situation where it's bang on full employment, everybody's happy, but more likely the economy is going to either be below full employment, in which case you've got a deflationary gap which you need to try and close by injecting into the economy, or you're going to be operating too hot in the economy, and the actual aggregate level of demand is beyond full employment in the model, and therefore we need to have leakages in the economy and shrink the aggregate demand down via the Keynesian multiplier system, and try and settle it at full employment. So we have the ideal situation in theory for governments is to achieve their economic objectives at one go. So they want stable prices. In other words, they don't want inflationary or deflationary gaps. They want full employment, and they want economic growth. All very difficult to achieve, because in order to achieve economic growth, you've got to stimulate the economy. So these objectives are conflicting, but nevertheless, that's what they want, and they want a stable balance of trade, open economy, exports minus imports, and also, just to throw it in, they want a fair and equitable distribution of income, right, so that they're voted in next time, presumably. Right, so that's where we are. We've talked about this idea of exogenous and endogenous variables. Exogenous outside the model, endogenous within the model, and that's a sort of variation on the theme of autonomous or non-autonomous consumption. So consumption, for example, is autonomous. It's not related to the consumption function. It's independent, or it is related to the consumption function. It is a function of income. Right. So that's where we are. I hope that was useful. I know it's a whistle-stop tour, but if you carry on watching these videos, once we've built up the language, we'll gradually get to the point where we can actually use this in terms of the full Keynesian transmission mechanism, and we can actually see how economic data, as it comes out from the economic calendar in trading terms, how it actually impacts through the economy and works through to the final product, in our case, which is FX pairs. So I hope that was useful. See you again for the next economics video. Thank you very much.